Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Brad Bourne from Firan Technologies back for an update. Firan trades on the TSX Venture Exchange under the symbol FTG and on the OTC under FTGFF. The company is currently trading at $2.50 with roughly 24 million shares outstanding, or about a $61 million market cap. I'd now hand it over to Paul Andriola.
Hey, thanks, Trevor. Great to have Brad back. Firan is a company that we looked at. We interviewed you, Brad, about 5 or 6 months ago. And what I've noticed is, since then you've been very active, very busy. So great to have you back. Great to get an update and sort of get into what's happened over the course of the last 5-6 months. But before we do that, why don't we sort of hand it over to you, but remind everybody what Firan Technologies is all about.
Sure. Okay. Thanks, Paul, and thanks, Trevor. One minor correction to what Trevor said. He said we're trading on the Venture Exchange. We trade on the TSX.
Correct.
But with that, let me go through some slides, and it will give you a quick reminder, or if you're new to the call, quick understanding what FTG is all about. Then I will definitely get into some of the work we've been doing over the last 6 months. So first, just a standard disclaimer that about forward-looking statements. You can read that later. Company overview. So FTG, our market focus is aerospace and defense. That's the only market we're interested in. Within that, we have 2 product offerings. We do cockpit products, and that runs under the name FTG Aerospace, and we do printed circuit boards. That runs under the name FTG Circuits. But again, in both cases, we only sell into the aerospace and defense market. The FTG of today, 7 facilities, generally paired together with one exception. So in Toronto, where we started, we have a circuits facility and aerospace facility about 10 minutes apart. In Chatsworth, California, we have a circuits facility and aerospace facility about 2 inches apart. In China, we have a cockpit product business, FTG Aerospace Tianjin, and a joint venture called FTG Printronics doing circuit boards about 10 minutes apart in Tianjin. And then lastly, a standalone in Fredericksburg, Virginia, we have an FTG Circuits facility that we acquired in 2019. Last few years have been interesting for us. Definitely the aerospace market was impacted by the pandemic. So if you go back to pre-pandemic, our sales were 112 million. Last year in 21, they were 80 million. Our 22 year is done, but we have not reported it. So all I can talk about right now is the first 9 months of 22 were 66 million. But generally we're seeing between the 10 and 15% recovery in 22 from the bottom of the pandemic 1 year prior to that. We have 475 employees. That's already mentioned. 24 million shares outstanding. Oak West is our largest shareholder with about 20%. Followed by me at about 10%, and then so on down the curve. A quick lesson on FTG, so the economics of the company. We are a manufacturer. We have significant fixed costs, but 30% of our costs are fixed. The rest are variable. The only reason I mention that is as revenue goes up or as revenue goes down, you get either a big benefit or a big impact because of the fixed cost, and we like it better when the revenues are going up. The other item on this page is the exchange rate. The aerospace industry basically operates in US dollars, and so the exchange rate between Canadian and US dollar matters to us primarily for our Canadian operations. Hopefully this is the last time I'm going to talk about it in any presentation, but so there was a pandemic. A little bit of data on it. So this is US air travel, because that really ultimately impacts the aerospace industry. You can see air travel basically went to 0 in 2020, and then it slowly recovered. And I didn't quite run this out all the way to the end of 22, but essentially US air travel has recovered to pre-pandemic levels. That's the good news. More directly relevant to us is commercial aircraft deliveries. So this goes back to 2018, and the blue bar is Airbus, the orange bar is Boeing. So 2018 was a great year. 2019 started to get a little complicated because Boeing stopped shipping 737s. Then the pandemic hit, so Airbus dropped off, Boeing dropped off even further. But you can see the recovery building back, starting in 21 and building back in 22. But still, this is not quite back to pre-pandemic levels. So there is still a little bit of work to do to get the aerospace business back to where we were in 2019, and hopefully beyond that. So what did we do during the pandemic? Very quickly, really three things. We've always said we want to be in a range of markets within aerospace and defense. So we talked about, we play in the air transport market, which is the big plane. We play in the business jet market. We play in the helicopter market. We play in the simulator market, and we play in the defense market. And they really do all move in their own cycles. And therefore, as various segments go up or down, we hopefully have a more stable revenue stream. Now, certainly what happened during the pandemic was painful, but the fact that we're not 100% in commercial air transport made it a little bit less painful for us. Secondly, we did manage costs across the company. When the pandemic started, we didn't know what to expect, so we just hunkered down. And we managed the balance sheet. And amazingly, coming out of the pandemic, our balance sheet is stronger than we went into the pandemic with. But as noted at the end there, we did play defense for 2 years. But where are we today? And really our focus in 22 is we had to change FTG's mindset, and we worked really hard on this. You can't win if you only play defense, so we're not going to just play defense. We are playing some offense now, both in terms of internal activities, chasing, winning new work, and certainly corporate development. I'm going to talk a little bit about that in a few minutes. And we're taking advantage of our balance sheet. As I said, our balance sheet's the strongest it's ever been, so we're pursuing new sales opportunities. We're investing in equipment across our facilities. We're investing in R&D, investing in new programs, investing in acquisitions, and even looking at capital allocation and strategies, things like a share buyback. So financial performance over the last number of years, not a great chart, but this is what happens when a pandemic hits the industry. So 2019, we peaked at 112 million revenue. I've really already touched on this, went down to 80 million last year, and we were growing at about 10 to 15% this year when that becomes annualized. On EBITDA, as I said earlier, top line drives bottom line in this business, a little bit of a multiplier. And so our EBITDA has really the same shaped curve. Semi-complicated chart, but this ultimately is hopefully showing a bit of good news. So the blue line is revenue from the beginning of 21 through the end of Q3 22, so 7 quarters of data. You can see the revenue, not a perfect line, but is increasing as the industry recovers. And then the orange bar and the gray bar are adjusted EBITDA and adjusted income, taking out the government support. And, it proves a couple of things, but first and foremost, just proves that, we really did need government support, both in Canada and the US, to get through the pandemic. And we took advantage of the wage subsidies in Canada and the PPP loans in the US, and they really kept us going through the pandemic. But as we got into the last couple of quarters of 22, the government support is gone, which is probably appropriate. And our revenue has recovered sufficiently where we are profitable now without the benefit of any government support. And so if the industry can continue to recover, hopefully this trend will continue into future quarters. Balance sheet, we've always had a great balance sheet. We ended 21 with the best working capital ever. And in 22, you can see working capital drop a little bit and cash drop. We actually bought one of our buildings in Chatsworth in this year. It was really a defensive move. We like to lease our facilities, but the building went up for sale, and to protect our operations there, we bought it. Our intentions for sure are not to own it long term, but to do some form of sale leaseback, which we are in the midst of as we speak now. And then, so looking forward, I decided, how could I project this forward? And really, it's what I said a minute ago. So Q3 22 is our latest quarter we've reported, and it's the baseline. And so that's what you see in the top and in the middle section, just our Q3 numbers. If you annualize those, it says, our run rate is about 92 million. Our annualized EBITDA would be 11. Our income would be 2.9, and earnings per share would be about 12 cents. That's a baseline. And then, as I project into next year, what could I expect? We're going to see, give or take, approximately $10 million revenue growth this year. So if that repeated next year, given our fixed cost I talked about earlier, 10 million in incremental revenue could add 3 million in incremental EBITDA and pre-tax income. And that really just rolls forward into the table at the bottom of the page. Our estimate for next year would be 100 to 105 million of revenue, 13 to 15 million EBITDA, 5 to 5.5 of income, and 20 to 23 cents of earnings. And that, I guess the key on that is this is all about ramping operations. Right now this year, our demand is ramping faster than we can ramp operations. And so if we can continue to ramp our operation next year, I'm not worried about the demand side of the equation. The key is, can we ramp our production to get back to these sort of numbers? I think we can. As I said earlier, our high point was 112 million in sales. This is still not back to where we were pre-pandemic, but it's getting us there. Corporate development. So as Paul said, we've been busy. Really, the key thing for us that really is a great add-on and a great leverage for the company is we've announced 2 acquisitions in the last couple of months. Announced acquiring a company called IMI near Boston. They do RF circuit boards for the defense industry. And then a week or so ago, we announced a deal for Holiday Circuits based in Minnesota. They do high technology circuit board for the aerospace and defense industry. Both great fits for the company, very aligned with our market focus, very aligned with our product offering, adds to our capability of things we can sell to our customers. And I guess having said that, the key thing on both of them is we are a foreign acquirer, so any deal to acquire a U.S. company now needs essentially U.S. State Department approval. And so we're working through those approvals for both of these acquisitions. And generally, this is a 2 to 3 to 4 month process, depending on the government. And we certainly do not control the government timeline on these. Delving into them in a little bit more detail. Excuse me. IMI. As I said, focused on the RF circuit board market. It's a bit of a niche market, but it's something all of my customers have some spend in. IMI's largest customer is a company called Mercury Systems, new customer to us. So that could be interesting. IMI, interesting enough, was not impacted by the pandemic, but again, because really they're focused in the defense market. Price we paid for IMI was 1.6 million US, so relatively small acquisition, and at a great multiple. We bought it, depending on how you do the math, between 2 and 3 times recent EBITDA. So, very low multiple, which I think will be great for us. We are waiting for the CFIUS approval. That's U.S. State Department. We do see some cost savings and cost synergies post-closing, but we'll also expect to see some higher rent. Basically, the current owner of IMI owned the building as well and was, doing what made sense for him, but it was really not market rent. So we're going to ultimately probably net out about break even on cost savings and higher rent. We definitely can protect future income with some FTG US tax losses, so that will be good for the future. A little bit of incremental CapEx planned next year to improve the facility and add some capacity, but nothing that overall is really material to FTG. And we're assuming consistent performance in 23 and beyond. You can see the table below. It's been pretty consistent over the years. And then I guess the key for us is IMI has had 0 external sales team. Really, the owner was selling when he got a moment. But we're going to bring our team of 8 people across North America and hopefully be able to expand their business in the future years. The results are, as you can see, kind of ranging in the 3 million of revenue over the last number of years, ramped up a little bit in 22. EBITDA's more recently kind of run in the 500, 600, 700,000 range, and income in the 300 to 500,000. This year's been a great year for them. Hopefully that can continue into the future. So it's going to be a good ad for us. Not huge numbers, but nice little tuck in. The good news is, from an integration perspective, our intent is to run it as is where it is. So integration is going to be very simple, relatively low risk. Holiday, a bigger story for sure. So Holiday's business is aerospace and defense, high technology circuit boards. That on the defense side, that's something that's really been something we wanted to add. Our goal at FTG has always been to try to be a one-stop shop for our customers across everything they need. Right now, our high-end circuit board shop is in Toronto. They can do aerospace and defense, but not all the defense, because some of the defense stuff will not leave the US. With the addition of Holiday, we believe we can penetrate some of the US defense, or the US only defense market, with the capability that Holiday has. They're big customers, they have been our #1 target for over a decade. They're truly a great fit for FTG. As I said, they fill a hole in what we can offer to customers. Their business is very aligned with what we do. We compete with them everywhere we go. You know, we win some, they win some. So putting us together, I think it's going to be just great upside for the combined company. Their big customers are Honeywell, BAE, L3Harris. Their business was impacted by the pandemic. Their business really follows a very similar curve to what we saw at FTG. This year, their orders have recovered like we've seen our orders recover. Their production is not really ramped due to staff shortages. There's a big challenge right now. Demand is not a challenge, but their staffing was about 190 people in 2019. They're currently at 150. They've essentially added no people this year. I think they just took a little bit too long to get started to really try to add people, and that's hurt their ability to ramp. It's reflected in their lead times. Their lead times for products historically were about 8 weeks. They're currently at 26 weeks, so their demand is greatly outstripping their ability to produce product. Our price for them, a little bit complicated. There's a base price and then an earnout, but the base price is $17.6 US with an earnout of up to $4.4 million based on future performance over the next 18 months. Our valuation on this, a little bit higher than IMI, but still a good multiple, about 4.4 times. 2019 EBITDA, and again, that's before the earnout part of the price. Same as IMI, we're awaiting CFIUS submission and approval. Hopefully we're getting the submission in today or tomorrow. And hopefully get good news by the end of Q1 or maybe early Q2. Definitely there's some cost synergies. We expect post-closing. We've compared materials we buy and what they buy. We can save some money on the cost side. I think there's some pricing opportunities. Tougher to put a hard, put your finger on this because we don't build the exact same part numbers, but I do believe there is some pricing opportunities to move this, move the revenue up and move the margins up. And again, on the sales side, Holiday has 1 salesperson. We're going to bring 8 more, so hopefully we can continue to add, some revenue to them. Again, FTG has US tax losses that can shield some Holiday income for the next little while. And then as we look forward, we expect them to build their revenue in 23 and hopefully get to around 1 to 2 million EBITDA, and then get to a full recovery in 24, back to that $3 to $5 million EBITDA. A million numbers on the company, the last number of years, really 2017 to 2019 is pre-pandemic numbers. I like 2019, that was where we were all at pre-pandemic, so they did over 31 million of sales and 4 million of EBITDA. 2020 and 21, 21 was skewed by a bunch of government support in the US. 22 looks kind of scary, but if you look at it by quarter at the bottom of the page, you can see their throughput, not necessarily the revenue, ramped from Q1 to Q2 to Q3. Their EBITDA ramped, and their income or loss was reduced. Their key, again, has been not a lack of demand, but a lack of ability to ramp their production due to staff shortages. And that's certainly the number one priority for them and us, is to get some more people in the building so we can ramp production and get them back on the sort of numbers they were pre-pandemic. So what's this, when you put it all together, so FTG in total for 23, we're assuming 9 months of IMI and 8 months of holiday in 23, so not full year due to the State Department approvals. But with these acquisitions, we're looking at revenue in the 125 to 130 range, EBITDA 15 to 17 million, earnings 5.7 to 6.5, and 20 to 27 cents of EPS. And I just put comparison there to 2019. We look like we could, with the acquisitions, get back to and above where we were in 2019 pre-pandemic. And then just looking forward to 2024, didn't put a lot of detail in here, but if we see continued growth in the market, get the full year benefit of the acquisition, and get holiday back to pre-pandemic levels, I think we're looking at an EBITDA of $20 million for FTG consolidated. There are upsides and downsides in all of this, or risks and benefits. Upsides, if we can get holiday ramped faster, that would be an upside. If we can pass through higher than anticipated price increases, that could add some upside. If we find more than expected cost savings, another upside. And then certainly we've not factored in any customer synergies from any acquisitions. So that could also add a benefit. On the other side, there are still supply chain disruptions, something that I think we've done a good job mitigating so far, but we'll see how that goes next year. If there is higher inflation on our raw materials than we anticipate, that could be a downside. And similarly, if there's lower than expected cost savings from the acquisition, another downside. And not related to the acquisitions, but certainly, as I said right in the beginning, any significant change or strengthening Canadian dollar is a downside for us. And then lastly, there's just a little bit of rumblings these days about there might be a recession. And of course, that would be something that would create a downside overall for the company. Capital allocation, cash management, an important part of what we're focused on FTG these days. First thing, in terms of capital allocation, our 3-point plan: invest organically to ramp throughput and drive technology. We did implement an NCIB this year to buy back up to 5% of our outstanding stock. As of this moment, we bought back about 500,000 shares. And then thirdly, to pursue corporate development opportunities, which is what I just talked about. So that's what we've been focused on, to deploy our cash. And the goal is to deploy our cash to improve our profitability, improve our returns, and definitely play some offense. On the cash management side of things, a lot of bullets on this page, but all of them are important. FTG has always been a consistent cash generator for the last number of years. We ended Q3 22 with a substantial cash balance. We have a $20 million US bank facility. We were approved for Canadian ARRI funding, which is Aerospace Regional Recovery Initiative funding from the federal government, for up to $7 million. That gives us an interest-free loan through 29. We are in the midst of completing a sale leaseback of our Chatsworth facility, which would generate $8.5 million, which is what we paid for the facility. We're actually repatriating cash from our China facilities. They've had a great couple of years. They're throwing off lots of cash. It's not trivial to get money out of China, but we've actually got some back already and working to get a little bit more. We're pursuing a second round of government financing for up to another $2.5 million, which would be interest-free for 2 to 3 years. And at the end of all that, we can complete these 2 acquisitions that we've talked about and end up with a strong balance sheet and a minimal bank debt. A lot of numbers on this page, but really this is just sources and uses of cash, the top is the acquisitions, IMI, holiday base price, holiday earnout, combined is about 31.6 million Canadian. How would we finance all of that? We start with our cash balance we had at the end of Q3, take out the cash at the US or at the China sites, add back the cash we are repatriating from the China sites, sell the facility in Chatsworth, use some of our government funding. We're pursuing some US funding as well. Some of the additional government funding, and at the end of it all, about $5.5 million of bank debt. And that would be our total bank debt to be able to do these two acquisitions. So our balance sheet would remain strong. Most of our debt would be on interest-free government debt with just a small amount with our primary lender. So quick summary. So definitely the pandemic hurt FTG in 2021, reduced demand, created lots of operational challenges, but we got through it. The aerospace market is truly recovering fast. We're leveraging our balance sheet to invest in operations, invest in technology, grow, buy back shares, complete acquisitions, and really drive improved financial performance. And we are playing offense across all of our initiatives right now. And that is our quick story and quick update of what we've been doing over the last 5 or 6 months.
Fantastic. Thank you, Brad. I'll remind everybody, if you've got a question you'd like me to ask Brad, please use the chat function and I'll do my best to ask a question. Brad, these last two acquisitions you've done here, I mean, were there any shares issued for the transactions, or is it strictly a sort of call it a cash sale?
Yeah, both of them are pure cash. We are definitely not issuing any stock right now. You know, we're actually, I guess, doing the opposite. We are doing our NCIB and buying back some of our stock because we do believe it has been undervalued for the last number of months. But the acquisitions, pure cash.
Fantastic. Now, you sort of talked about some of the challenges you're facing, and I can see that, and we're hearing it from so many other companies, trying to staff or trying to get qualified staff. I got to imagine that's not exactly super easy in this environment, or is it for you guys?
No, I mean, it's not easy, but it's also not impossible. You know, if I look at our Toronto facilities, we're putting together a little bit of data on this. So in the last year in Toronto, so both facilities in Toronto, we added between 15 and 20 people as the business ramped back up. So it's not huge numbers, but we didn't manage to find people and fill most of the holes we needed to get filled. But and I'm gonna just go back to Holiday a little bit. They have not added this year, and I think I guess a number of things. I think they got themselves distracted because they were selling the company, and so they were more focused on that and not focused on dealing with operational opportunities that they should have been dealing with within the business, and they're just slow off the mark. And so they really through the year through the full year they did not really add many people, but in December I did see them starting to make some offers and get going on this. So it's not going to be trivial, but it's also, I don't think it's impossible. I think it was just a bit of a lack of focus on their side to get them to where they are right now.
Now, I mean, two acquisitions in the last, at least announced in the last few months. It'll take a while to get approval and sort of integrate. But are you guys still on the prowl for other opportunities, or are you going to sort of digest these for a while and then get back out there?
Yeah, a bit of both, if that's possible. For sure, the priority is get the State Department approval, get these closed, because these acquisitions are not actually closed at this moment. But the way things have played out is the exact opposite of what I expected. I expected there were going to be opportunities through the pandemic because people were going to be struggling and activity was down, and there was nothing, no discussion, no activity during the pandemic. Now that it's over, there's opportunities everywhere. So we got 2 across the goal line, or almost across the goal line. We're focused on getting those done. Integration is going to be relatively straightforward because in both cases they're buy them, run them as is, where is, so it's a pretty simple integration for us. And we will continue discussions with anyone else who is interested in talking to us. And, I don't think there's anything imminent, but, we'll see where the discussions go. And if someone's ready, we'll talk to them.
Perfect. And then just generally, I mean, we're hearing so much more about onshoring, sort of North American business coming back to North America, or North American manufacturing coming back. Are you seeing that? Is that something you can take advantage of? Obviously, with the rules around defense manufacturing and products like that, it's got to be U.S. focused. But outside of that, are you seeing other evidence of sort of that demand from onshoring? Let's call it.
Yeah, I cannot decide. For sure, we're hearing lots of discussions about onshoring, and we're talking with some customers about onshoring. But we have operations in China, and both operations in China had record years in 22. And I can't reconcile these things. There's all sorts of discussion about onshoring, but yet my China operations are growing, faster than any other sites at FTG right now. So what can I say? I'm seeing both.
Gotcha. So, but on the aerospace side, so we leave out defense. Are you seeing any pockets geographically that are growing faster than others? Like, is Asia growing faster than North America, or Europe is growing faster? What do you see?
Yeah, the aerospace market's a very global market. It's hard to say it's growing in one area or another area. I guess what I would say, the two big players, Boeing and Airbus, and both of them for sure global, both of them are operations around the world. Airbus is outperforming Boeing, and it's just Boeing's had a tough couple of years. Some partly due to the pandemic, but they had their significant challenges around the 737 MAX, and so they halted production on that for almost 2 years. There's 787, which was a great plane for them, and we have lots of content on. Had the same thing. Their production halted for the best part of a year as they went through some concerns and issues with the FAA. That's just ramping back. So it's more of it's not a geographic thing, but as I say, Airbus has outperformed Boeing over the last couple of years, just in terms of operating performance and not having to deal with some of those challenges.
Gotcha. And then I would imagine visibility is getting better now that we're out of the pandemic and things are sort of right sizing a little bit more. Do you guys have a sense, or do you even give any kind of backlog numbers? What kind of does the business look like now? Let's call it on a pro forma basis with these two acquisitions.
Well, with these two acquisitions, I have no idea. What I was going to say, and I got to be a little careful, right? So our year end is over. We have not reported, so I can't really talk a lot about our year end situation. But typically, at the end of a quarter, we will report backlog. The one thing I would say is our backlog, excluding acquisitions, is the highest it's ever been, without getting into details of it. With the acquisitions, it's going to be higher, but I haven't really done pro formas or really looked at what the backlog looks like. But demand is strong everywhere right now, and so I keep saying, demand is not the issue; it's the ability to produce, which is driving our future performance.
Right. And of the two, sort of aerospace versus defense, give us your crystal ball sort of expectations. What can we sort of expect in terms of, and I'm not asking for percentages, but just give us a sense of, are we going to see ongoing growth in defense? Are we going to see more out of aerospace? What do you think is likely to happen?
Yeah, we're going to see growth on both sides. And the easiest metric to track on the defense side is just U.S. defense spending, because U.S. spending is such a key part of the overall defense spend for the world. But they're spending, their budget for next year is higher. I'm going to say mid-single digits, something like that. And what's unfortunately driving that is things like the situation in Ukraine. The defense spending is becoming a topic of interest for a lot of countries right now because of what's going on there. So that defense is growing, and at the same time, the aerospace market is growing. We're coming back from the pandemic. For sure, the aerospace market is growing faster than defense right now. And it's just, the demand is coming back. Airbus has a backlog of, I don't know, 5 to 7 years of production. And they're looking at ways to increase their production rates on their key planes, which is really the Airbus A320s. They also now have the A220, which was Bombardier's plane. That has a great backlog. They're doing a great job of selling that. So that production is ramping. And then Boeing is coming back to life. As I said, they had a couple of planes that were in production for a few years, and that was super painful for them. But they're trying to get back to near pre-pandemic levels in a couple of years, which is like 50% growth for them to get back to those levels. So commercial aerospace market is growing aggressively right now, and this might be one of those unusual moments where we say we play in all these different segments, and all of them are growing. We don't see some up and down or some down. They're all in a growth mode at this moment.
And sort of from an investor standpoint, so from us, looking at you guys right now, what do you think is the things that we should focus the most on or pay the most attention on? Maybe future catalysts that could happen, or industry shifts. What do you think makes the most sense to pay attention to?
For sure, we got to get these acquisitions across the goal line. And, that's important. I don't think that's a critical issue at this point, but we got to get it done, and maybe get it done in a timely way. But I'm not worried about that. I'd say it really just come back to what I've said a few times, which is, if we can ramp our production, we will outperform the industry, and we will be able to grow our market share and keep our customers happy. And it's really about operating performance right now for us. Assuming the acquisitions are, done deal. If we can get everyone ramped, you'll see the revenue grow, and we get great operating leverage from growing top line, which will drive profitability. And it sounds simple. It's certainly, there's lots of moving parts to operational performance, but that's what it's all about for us right now, and that's what we're focused on.
Brad, you're still a microcap by a lot of definitions. Certainly the news of this acquisition has helped the share price. But are you seeing any, added interest from the investment community or analysts? I know there's a couple of analysts, at least one following you right now, but is there been a change in sentiment around a company of your size right now? Can you mention anything?
It's certainly the holiday announcement generated more interest than we've seen in the last year or two. And, as we hunkered down, there was not a lot of people paying much attention to us. Holiday seems to have woken them up. Maybe our timing is not perfect, announcing this deal, a couple of days after Christmas, but, we are definitely, I'm seeing a lot of institutional investors trying to circle back with me to understand what's going on. People like you are reaching out to me. We're seeing some other people, asking for meetings. So a lot of attention really starting this week once people got through the holidays, which is good. And I do think it is the holiday acquisition is a material deal for us. It's a game changer for us. Significant upside revenue and profitability. So people are taking notice.
Yeah, no, I think the sort of the numbers around the acquisition certainly looks quite appealing, and it's just good and encouraging for us microcap investors to see others start to pay attention and ideally sort of come down market and have an effect on a great business like yours. One question I got from somebody is around Oak West Limited, which owns about 18% of the company. What can you tell us about that investor and that holder?
Yeah, I love them as an investor. Oak West is actually a family fund. It is the Butel family in Toronto, and Oak West is their business. And they invest in various companies. They invested in FTG, I don't know, at least a decade ago. They actually, at one point, owned almost half the company. and have slowly taken money off the table as the stock price moved up. But they're a long-term investor. They are, they understand the business. Robert Butel, who runs Oak West, is actually on our board. And he is a great board member. He, really provides great advice and really makes our board meetings, super valuable. And yeah, that's long-term investor, been great for us, and they made a lot of money off us. So it's been good for everyone.
Win-win for sure.
Right.
That's awesome. Listen, I mean, this has been great. This is just what I was hoping for, is a nice update like this. But Brad, is there any sort of key messages or maybe anything we may have missed that you want to make sure that everybody walks away with today?
Yeah, and I might start with a little bit of a negative side, but one of the concerns of FTG had been, over the last couple of years, we had somewhat of an inefficient balance sheet. We were sitting on a lot of cash, not generating much return for it, and maybe there's a second concern earlier this year when we bought the facility in Chatsworth that was not a great investment because it doesn't really generate return. And I heard that from shareholders, and I agree with that. I agree with both of those. The good news is, we've been working hard on it, and we've solved the issue of the investment in the facility in Chatsworth. We are in due diligence and hope to close the sale of that building shortly. And then more importantly, we have deployed the cash that we had on our balance sheet, I think, in a couple of great acquisitions where we're really going to generate good returns from them. And so we listen to shareholders, I like the inputs from shareholders, and I think we've addressed them to make FTG better than it was pre-pandemic.
Fantastic. Well, listen, Brad, congratulations on the progress so far, and certainly congratulations, maybe a little premature, but it looks like not much of a hurdle to jump over for these acquisitions. I want to thank you for spending a little bit of time with us today and getting us updated, and certainly look forward to catching up with you in the near future.
Great. Okay. Thank you, Paul. Thank you, everyone.
Fantastic. We've been speaking with CEO Brad Bourne, Firan Technologies, FTG on the TSX. We'll catch up with you soon. Thanks again.
Thank you.